Thank you for checking out Fieldman, Rolapp Associates Municipal Market Update for the week of March 20th, 2023. Our data is as of March 17th, 2023. Fieldman, Rolapp Associates is a municipal advisor to government. On a monthly basis, we post a municipal market update, or we also call that MMU. And that what we're trying to do is give our clients a monthly update on what's going on with the municipal market and how some other factors contribute to that. This is our 46th posting. My name is Adam Bauer, and I serve as CEO and president of Fieldman, Rolapp Associates. Over the last 2 weeks, we've had a lot of financial news. The Fed chair wraps up his testimony, and I think all parties expected a 50 basis point increase in the Fed funds rate later on in the month. A few days after that, the 16th largest bank in the country, Silicon Valley Bank, fails. A few days after that, a bank called Signature Bank in New York gets taken over by the state of New York. That leads to the federal government deciding to guarantee an amount over the FDIC amount of $250,000 to give those depositors in those two banks comfort. However, the other regional banks didn't have the same guarantee. And so that has caused concerns with those, and that continued last week. So much so that a group of competitive banks put money into First Republic to help provide some confidence amongst their depositor base, that if the competitors are investing in them, hopefully that gave that group some confidence. But then over the weekend, UBS takes over Credit Suisse. And so now this concern that appeared to at first be concentrated to regional banks is now much broader than that. All that has led to investors wanting things like treasuries and municipal bonds, which has driven down those yields, and we'll get into some of the details of that. On our first page here, we have a new chart for you. And like a lot of financial charts, it starts off to simplify things, but then we layer in so many things so it gets complicated. So I'm going to try to break this down. Let's start with those green bars. And the key for those green bars is the vertical axis on the far right. And what we're trying to show you there is how the Fed funds has increased over time. So go to March of 22. You can see it got increased by 25 basis points. Then you go to May, and you can see it got increased by 50 basis points. But then June through November, 75 basis points. And then you can see 50, then 25 basis points after that. So what that's trying to illustrate is just all those changes that the FOMC has made over the last year or so. Now that data is used to create the yellow bars there. The yellow bars is the Fed funds rate, and you can see how that's gone up as those rate increases have kicked in. What you also hopefully see is at times the 10-year treasury is trending along with that. So if you look at like March through June, definitely see an upward trend through that, and then August to November as well. And so that's really that shift in higher rates and how the Fed funds has impacted that. One moment. So the reason why it's so important to talk about the 10-year treasuries, I've oftentimes told you in these MMUs, is that is a key bellwether to monitor, and oftentimes can help give you an idea of where interest rates are trending overall. And so that's why we've layered that US Treasury along with the Fed funds rate. And so what we detail here is a US Treasury yield curve. And if you look at that blue line, that 1/3/2022, that is really the day that investors started recognizing that inflation might not be transitory. And while the Fed did not start increasing rates until March of 22, I think investors knew it was coming. And so you started to see some change. But one thing I really want to point out to you, one is how much lower it is than it is now, because that greenish line is as of 3/17/2023, but how different those two lines are. So you can, if you look at the blue line, you can see as an investor lends for a longer period of time, they get a higher interest rate. But look at that green yellowish line, and you can see if an investor loans money for 1 year, it's actually a higher interest rate than if they did 2 years, even 10 years. You can see that's an inverted yield curve. And you can do all sorts of Google searches and find out all sorts of things about what that may or may not mean. But for our purposes, just wanted to show you the different, one is the gap, how much higher interest rates have been since that early January of 22, and then how much that yield curve has changed, gone from a more standard upward sloping yield curve to an inverted yield curve. And then this chart or table tries to quantify how things have changed over time. And now the shorter end of the yield curve has adjusted by a greater fashion than the longer term, but we did stick with the 30-year yield curve here. And so just generally show you how it went up over time or gone down over time. You can see if you look at January, it decreased by 37 basis points by the time you get to February 1st, 2023. But then that all got given up in February. By March 1st, you can see that there as well. But in the first part of March here, we have seen that go down a bit. But just generally give you some idea of how things have changed over time with that 30-year MMD. To pause for a moment, the MMD is that municipal market data. That's a key gauge of municipal interest rates. And the 30-year is one that we've shared with you many times. But this chart does not focus on the 30-year MMD. It focuses on years 1 through 30, each one of those maturities. What the bars in this chart show you is that the range of interest rates going back to 2005. And what that bluish line shows you is where the MMD was for each one of those maturities on 3/17/2023, so last Friday. So hopefully what you're noticing on the long end, it's just maybe a little under average, and on the short end, it's a bit over. So on the short end, we're a little bit higher than historical averages, but on the long end, we're probably right at or just a little bit lower than historic averages. And when I showed you that yield curve of how it's inverted, you see that illustrated here. Now, we put a lot on this chart, but we're really trying to share a few things in a short period of time with you here. Is the monthly issuance volume. And you can see we go back to 2019 and just showed kind of how that's changed over time. So in January, you can see some pretty consistency. It's always a light month, but it's generally pretty consistent. February, look at 23, that light blue line just drops off. So it's quite a bit of difference. March, we'll see. But at first glance, it appears to be a lighter month than in recent history. Now go to the far right there. What we're showing you is some kind of different types of sales. All of them are generally down a bit from the last 2 years, but you can see when you look back at that, they generally declined, and 2023 is just a little too early to tell. So then on the bottom left there, we showed taxable versus tax exempt. And 2020 and 21 really stand out with those kind of yellowish color. And what that's demonstrating is when the taxable rates got so low, the industry did a lot of taxable refinancings. And you can see that's why we had so many taxable series there. But now that that is no longer the case and taxables are much higher, you see much less of that. And in 2023, expect that probably even less than what we saw in 2022. And then the far right there, you can see just new money refundings or combined. And I think what you'll probably notice there is that the refundings were less in 22. And that's in large part because interest rates were so much higher than they were in previous years. And that rates were so low in 20 and 21 that you got a lot more done. You got a lot more deals that might have been done in later years done in those years just because rates were so low. So deals got pulled forward there. And then finally on this chart, we show the inflows and outflows from municipal bond funds. If it's yellow, you see money flowing out. If it's green, you see money flowing in. And so you can see since that late 2021, you've had substantial outflows with a few months that have gone the other way. One thing that we have heard quite a bit, though, is that SMAs, separately managed accounts, have seen inflows, or it's seen, they don't really call it inflows, but they've seen significant amount of funds. And so at times those monies have been used to buy municipal bonds. So maybe the demand is not quite as depleted as this chart may make it appear. And volume. So if you have less bonds, you know, kind of, or less, I'm sorry, if you have less interest in bonds, how is that affecting the interest rates? Here you see very low volume. So even though there's less investors that may be interested, there's so much less bonds available. That's one reason why you might have seen some of that pressure on interest rates. But you can see with these lines here, just that the light blue is lower than the green and yellow, the previous 2 years. And so you can see our volume is just quite a bit lower than it has been in recent memory. Finally, what I've told you about this slide is just a way to keep track of what's coming ahead. And if any of these come in substantially different than what's been projected, there's likely to be an impact. But most important one is this 3/22/23, and that is what the Fed does later on this week. And so that would be a key item to watch. So I thank you for your time. This MMU is a bit longer than some of our other ones, just because it's so much economic data or events, I should say, to take into consideration. But if you need more information, you can reach out to any one of our registered municipal advisors on this chart, and they'll be happy to help you. So thank you for your time, and look forward to talking with you in April.